It seems like when it comes to the U.S., this business cycle is still proving to be resilient. We look at the headline figures. But when it comes to the financial outlook, things seem to be darkening a bit. How does that change your view on whether to take risk or not in this environment?
Well, we're still going into the second half of the year with quite a bit of risk aversion. I think, a lot of the data, you're right. Job numbers are still pretty resilient. But if you look at the breakdown of your charts earlier, there's a lot of SMEs, there's a lot of service sector. You look at the big tech companies, they're still reducing. Some of the financial, some of the professional service, large companies are reducing. And if you look at, for example, corporate spending, CapEx, that's coming down. The housing market is cooling as well. So if you look at traditional triggers for recessions in the U.S., it's not consumer spending. It's quite often, and in fact, 11 out of 12 times, is either CapEx or the housing market or both. So I think we are moving into that direction, especially now with the banking sector also tightening their lending standards. You've got the usual suspects starting to appear that could push the U.S. to a much weaker growth environment, if not recession, later this year. So I think overall our assessment in terms of asset allocation is still somewhat conservative. Government bonds, fixed income, high-quality fixed income. Even in equities, we're looking at defensive sectors. And to some extent, maybe some of the growth stocks where it benefits from lower yields, and which is what you've seen in the first quarter of the year. But obviously, profitable companies. Not all tech companies are the same. Some are loss-making. I think they will be scrutinized still for much of this year.
What about treasuries? What do you think about current levels right now? 4%, say, on a 2-year, I think.
Well, I think there's more room for yield to go down. While inflation is still elevated, it's coming down very slowly. But I think the market's looking ahead into second half of this year, 2024, where the growth outlook is still pretty uncertain. And at the same time, you mentioned about the Fed, whether they'll still hike. If you look back to even in December, on their forecast, the consensus was for policy rates to peak at around where we are now. And that was at a time when the banking sector was still in reasonably good shape, the economy was doing okay. So I think unless we see a sharp turnaround in the inflation numbers, the Fed ought to be quite comfortable with where policy rates are right now.
How soon do you think they could cut?
Well, this is a great question. I think this is a much more of a sort of a digital or a binary outcome. If you have a mild recession, inflation coming down very slowly, then we may see only a rate cut in very late 23 or even not 2024. What the market's pricing in right now is something maybe a bit more of a banking sector stress scenario where things come down really quickly, growth come down really quickly, banking sector continue to be under stress, and maybe not just one or two a week, maybe multiple banks having problems at the same time. That could prompt the Fed to turn around and say, okay, well, we really need to take away some of the tightening right now. So that's the other more stressed, more serious scenario, which I think at this point we're still thinking is a small probability.